Okay, so we can start the second part of this topic. I call it topic 4, but even though it's only an extension of topic 3. Once again, the information is that the topic still remains corporate currency risk management. And this is the basis of your management accounting task 2. So your task 2 will be based on this. The next contract which we shall study is called options. And we shall specifically study the currency options, the currency options. Options are very widely used nowadays. In fact, options, if I have to name one contract which has skyrocketed in terms of the popularity of derivatives, it's options. It's a fabulous instrument. The highest, the best place, or the biggest place, or the most popular place where the options are traded is called Chicago Board of Options Exchange, CBOE. Okay, and most of the data is available in Chicago Mercantile Exchange. So if you ever go to CME.org, Chicago Mercantile Exchange, you will have lots of information about options. Options are very old contract, even though Amsterdam, Montreal, Philadelphia are very popular places. Nowadays, there are more European destinations, London, Frankfurt, they are very popular, or Luxembourg are getting very popular places for options. Options were once upon a time, I think, or I should say I should rephrase myself. Amsterdam was perhaps in the 18th century was the most popular place for options. Some time ago, I met my colleagues, friends in Utrecht, and they showed me a book written in Dutch, which shows that how popular were options during 1760s, 1770s. Unfortunately, I couldn't read it because it was in Dutch, but some of the contents I could get some idea that what would be their parallel, comparable English words. So it used to be very popular, but over time, Amsterdam has lost its shine in terms of option trading. The purpose of this contract is hedging and speculation. Hedging and speculation. I want you to answer me that have you followed in today's discussion anywhere I explained directly or indirectly about hedging and speculation. The purpose of option is hedging and speculation. What do you think? What do you say about it? What is hedging and speculation? Yes. Huh? Please.
Yeah. Is it buy cheaper and then sell more expensive?
Yeah.
Or just like hedging like that, speculating like that to earn money?
Yeah, but can I ask you one thing? Can I ask you one thing? What is the purpose of forwards? Why would you buy? When will you buy forwards and when will you buy futures? Who are you when you buy forwards and who are you when you buy futures? William, you want to say something?
Forwards when you play more safely, and futures when you play forwards.
Yeah, in forwards, when I say hedging, sorry, go ahead. Yeah. All right. Yeah. When you want to protect yourself against risk, then you are hedging yourself. For example, you are going to sell something to Australia and you are afraid of Australian dollar depreciating. You are going to buy something from Canada and you are afraid of Canadian dollar appreciating. Because you are a genuine exporter, importer, business person, buyer, seller, whatever you call yourself. Here you want to hedge yourself. Hedging, protecting. William used the word that you are defensive. I think something similar word you used. When you are hedging yourself, you defend. You want to defend yourself. You want to defend yourself against depreciation of Australian dollar and appreciation of Canadian dollar. So that's why you go for the forwards. But when you buy future, you take the bull by horns. You are aggressive. There are markets like a wave of fluctuations, ups and downs, and you don't want to scare, you don't get scared, you don't go and hide yourself. No, you go open in the market and say, hey, I will take advantage of this market movement. So for you, more volatile the market is, more fluctuating the market is, more is a chance that you will be earning money, getting richer. So you are aggressive in futures. And when you are aggressive, you are in a speculative mode, are you? So therefore, the purpose of forwards was hedging, defensive. The purpose of futures was speculative, aggressive. Here, you have both objectives. You can be both aggressive and defensive. Defensive when you actually have to pay somebody in Canada in 6 months' time, or somebody would pay you from Australia in 3 months' time. Aggressive, you are not really interested in taking delivery of dollars and whatever, but you want to be the beneficiary of the currency price movement, the exchange rate fluctuation. You love it. You want to take advantage of this market movements. Options, you take both virtues. So your trajectory is not only defense. You not only want to duck down yourself, but you also want to be aggressive. And and who are the participants? Well, the companies, financial institutions, banks, exchanges. These are the options. Could be both exchange traded or OTC. This is very interesting. Your forwards were OTC. Do you remember? Because it was a deal done between you and your bank manager. Futures are purely exchange traded. Remember the word marked to market. Market means exchange is marking you. This is both. This can be both, either market or OTC. When you buy the options from some option exchange, it's a market or exchange traded contract. But when you buy from the bank after negotiation, the four specific thing: specific currency, specific amount, specific time, specific rate of exchange. When all this done, the things are decided over the counter, over the discussion table. It can be OTC contract. Options. What is the literal meaning of option? Forget about finance. What's meant by option in English, normal parlance? Huh? No compulsion, but choice. You have a choice, but it's not obligatory. Nothing is imposed on you. So you have a choice, but no forcing, no obligation. It's not obligatory on you. It's a kind of additional benefit. You can have it, but if you don't want to use it, don't use it. Do you have this luxury in case of forwards? No way. What's the word? Lock in. When you lock in, you are stuck. You can't walk out. In case of future, it's only, there's no locking in. But this can be both. So it's like you may not honor it. Once again, you have the right to sell or buy. It means you can take long position or short position. For the specific, all the four specificity, you know it better now. There has to be some expiration date. The price at which you agree to buy or sell is called strike price or exercise price. The price which is called specific price, specific rate of exchange, that is called strike price or exercise price. Let's say we make a deal that we would buy Canadian dollars at 1 Canadian dollar equal to 75 European cents. It's a strike price. American options and European options. They have nothing to do with the geographical connotation at all. American options are those options which you can exercise any time before the maturity period. The European options are those which you can only exercise on the day of maturity, like forwards. Remember the forwards? You buy the contract, you have to honor on the day of maturity. Nothing happens before. If that is the case for options, which can be, then those options are called European options. But if you can sell or buy anytime, whenever it suits you, like futures, then those options are called American options. You can find European options in America, and you can find American options in Europe. So there's no geographical kind of distinction. Nowadays, most of the options are actually American options. Okay. The options are two types: the call options and the put options. Call and put. The call option gives the buyer or the holder right but not obligation to buy a specific currency, specific amount, specific rate of exchange, and specific time period. Does it make sense? When you want to buy something, it's called call option. Okay. This is how the option looks like. This is called pay off the option. I am, imagine, in the US, and I want to buy, let's say, pound, because I have to pay somebody in GBP after 6 months' time, okay? The specific price is 1.50. So this is the contract price. It means the price where I agree to buy British pound is 1 pound is equal to 1.50 American dollars. The premium is the price I pay to get the contract. You know, there's no free lunch. When you want to buy this contract, you have to pay some fee. All right. And the fee is 2 American cents for every 1 pound. That's a fee you pay. Okay. And this fee, by the way, is a non-refundable fee. Remember, you have the option to exercise or not to exercise. Is it an added advantage to you? Well, every add-on function has a price. And the price is premium. If you have some, but tell me one thing, do you know the difference? In forwards, lock-in. In future, you can exercise anytime before. Here you have both options. You have the option to honor the contract or simply forget it. You can simply forget it. For example, you can buy an option and just forget it. Nothing will happen to you. The only thing will happen to you is that you will forget, you have to forget these 2 cents also. Make sense? Now, what happens? I, in USA, want to buy, let's say, 1 million pounds. The price which I agree with my broker, let's say I buy in exchange, is a pound is equal to 1.50 American dollars. And the premium I pay, for every pound, I pay 2 cents. And this is called premium of option or price of option. Non-refundable. It will never come back to you. Today is April 4. The expiry will be May, June, July 3rd. 3 months contract. Okay. Now imagine I want to make a decision. Should I exercise the option or shouldn't I exercise the option? And on that day, the market price is 1.46. Now it's a decision-making time. But when I compare this price with the market price, let's say on July 3, the market price is 1.46. And then I check the option price, which I have a contract, is 1.50. Should I buy from the market or should I exercise the option? Today is what? April 4. And we bought a contract to buy 1 million GBP in 3 months' time, yeah? So the date of expiry is 3rd of July. And let's say 3rd of July comes. On 3rd of July, if I go to the market and buy £1, it will cost me 1.46. But when I see my contract price, it's 1.50. My point to you is, should I buy the option from the broker or should I forget the option and buy from the open market, for example, any currency shop? What should I do? Should I buy the option from the market at 1.46 or should I honor the option?
Market is more cheaper.
Cheaper. Yeah. But when you do this, you can be successful in doing it, but then you are losing something. 2 cents, which you paid in the beginning. When? Remember the time. This decision to exercise the option or not to exercise the option, you are making it on July 3rd. But don't forget, 2 cents you paid on April 4, and they are non-refundable. So when you choose not to exercise the option, what happens? You lose something. And this loss is exactly equal to 2 cents, which is this. Make sense or not? Tell me something. When you are in a similar decision making and the price is 1.48, the market price on July 3 is 1.48. Will you exercise the option or not? Will you exercise the option or will you not exercise the option? Why?
If I don't exercise the option, I have to pay them a premium of 2 cents.
You have paid premium anyways. You exercise the option or you don't exercise the option, this 2 cent premium will never come back to you.
But I have paid them. So if I go to the open market and buy it at 1.48, the amount of extra money that I make will be equal to the premium that I paid. So
No. See the situation. This premium you have paid on April 4, yeah? Now the time of judgment comes. The market price is 1.48. Where is the cursor? 1.48. And then this price you compare with this price, strike price. Forget about this 2 cents. They are gone. They are like arrow out of the bow. It will never come back. Is market price cheaper or is the strike price cheaper? Market price cheaper. So will you exercise the option or will you not? See, you exercise the option or you don't exercise the option, your 2 cents are gone. They will never come back. The question is now, do you want to buy the option from the market at 1.48 or you still want to honor the contract? Buy from the market, it's 1.48. At least you have lost 2 cents, save some 2 cents by buying cheaper from the market.
I'm looking at it from a complete picture. So say I have this much money. I paid the premium, so that is deducted from my total.
That's gone.
Yeah. So now, for example, if I buy from the market at 1.46, I've already paid the premium. So the extra amount of money that I make covers the premium plus I get some more out of it.
You see, if you buy, you're buying, you're not getting it, you're paying. Call option is a right to buy. You're buying it, not selling it. Call option, if you want to see from the selling point of view, then put option. My next question to you is very important. What if the market price is also 1.50 on that day? On July 3, the market price is also 1.50. What will you do?
I'll honor it.
Any ideas? It's July 3 and the market price is also 1.50. Will you exercise the option or will you not? Why will? What difference does it make?
Actually, I've already lost my 2 cents, right?
Mhm.
So for reliability,
I will do it for the relation.
yeah, for the relation.
Relation? Which relation?
Relation doesn't, it was a contract. I honor the contract.
No, but you have the option not to exercise it also. Nothing wrong. It's like if like a very open relationship.
I don't lose anything, neither do I gain anything.
Mhm. Actually, it doesn't make any difference because if you don't exercise the option, you buy something from 1.50 and forget this 2 cents as a bad dream. So altogether it costs you 1.52. But when you exercise the option, you buy from the broker at 1.50 plus 2 cents you paid on April 4. So it costs you same. So basically, we have a point of inflection here. On the left side of this, you would never exercise the option. And on this line, you will always exercise the option. Now, I want to ask you even trickier question. What if the market price is 1.51 on July 3? Will you exercise the option or will you not?
Yes, you will.
You will. Because when you exercise, you pay 1.50 plus 2 cent premium, total cost 1.52. But if you don't exercise the option and buy from the market, you pay 1.51 plus 2 cents you have paid anyways. So it costs you 1.53. So buying from the broker is 1.52. Buying in the open market is 1.53. So you save 1 cent. 1 cent from where? 2 cents you paid already. 1 cent you recover and your loss is 1 cent. Can you see? If I draw some fictitious point here, then you can see that the loss will not be 2 cents, but loss will be 1 cent. Isn't it? So by exercising the option, you lose less. What if the market price is exactly equal to 1.52? How much you lose or gain? Break even. So this point is called break even point. And anything above on this side is a jackpot. All right. So you can see that. Now here some points should be considered very, very carefully. Now I need your attention. So we draw this line, which is flat, then point the corner, the inflection and going up. Yeah. The stretch where you must not exercise the option is called out of the money option. So we use a phrase, sorry. This left point, left side, where you should never exercise the option is called OTM, out of the money option. There can be some grammatical errors sounding, but it's not my fault. It's a expression we use in the market, OTM, out of the money option. If you are at this point that you exercise or don't exercise, it doesn't make any difference. When you are in this trade-off point, this is called ATM. ATM, what is ATM? Not that ATM, but that ATM. This means at the money option. At the money option. And when you must exercise the option. It's called ITM, in the money option. So on this side, you have completely out of the money option, OTM. And when is that? As long as the market price is below the strike price, you should never exercise it. At the money option. When the market price and the strike price are same, then it doesn't matter. Like it's a point of indifference, like neutrality. But if the market price is higher than 1.50, you must exercise the option. All right. As a buyer of option, you would like to stay on this side of the picture. When you must use the option, when you must exercise the option. Look here, Alan, it's a complete no. Don't use the option at all, right? Here, may or may not, it doesn't make any difference. But at this stretch, this angular stretch, you must use the option. Even in the loss, look, 1.51, you have a loss, but this loss of 1 cent is less loss than the 2 cent loss. Right? So it doesn't matter, there's a loss. But when you are on this line, let's say this point, this point, this point, there's a loss because the point is below the x-axis curve. There's a loss, but this loss would be less loss than 2 cent. Okay, but if you don't exercise, then you lose 2 cents anyways. And this point is called break-even point, yeah? Okay, remember, exercising the option has nothing to do with the profitability. Here, we must use the option even despite losses, right? And here you have no profit, no loss, and here you have profits. So you decide to exercise the option, have nothing to do with the profitability. Even in the loss, sometimes you exercise the option because by exercising, you incur less loss than by not exercising. So profitability and exercisability are two different things. Then we see the point called break-even point you mentioned. So this is the payoff of the options. Which option? Call option. But if you see the beauty is that, where is the beauty? Oh, where is the beauty? The beauty is that you can gain indefinite amount. Look, imagine the market price of a pound is $50, but you can still buy at 1.50. Does it make sense? It means that your upside gain is potentially indefinite, but you would never lose more than 2 cents. Isn't it a beauty? That you know for sure that the maximum loss I can have is 2 cents, not more than that. But my gain is, in theory, indefinite. If this line goes up, all the way up, it could be anything. So your upside potential is huge, but your downside risk is less. No, I shouldn't say less, but limited. And the limit is 2 cents. You will never lose more than 2 cents. Yeah? The only time you lose is when you don't exercise the option, and then there's a loss. So that's the only loss you have. But if market goes up, remember when you're a buyer, it's good for you that the price rise in the future. And when the price rise, it's good for you. But then there is no limit on your profits. This is the payoff for the buyer of call option. And call option means right but not obligation to buy. This is the payoff of the seller of the call option. And who is the seller? If it is a OTC option, then bank is a seller. By the way, the seller is also called writer of the option, writer, not William Shakespeare or anybody else, but the one who writes the option. And in case of exchange traded options, it's the exchange broker who writes the option. Okay. But there has to be somebody who's selling it. If you see this picture, can you associate this picture with this one? This is the payoff or the position of a buyer of call option. And this is the payoff of the writer or the seller of the call option. Just the mirror image opposite. Now, I will not explain what would you do. The argument I'm trying to make is that the only time the seller of the option gains when the buyer don't use the option. All right. So you can see that the maximum loss of the buyer is 2 cents. The maximum gain of the seller is 2 cents. The buyer of the option can potentially gain indefinite amount. The seller of the option can lose indefinite amount. Imagine the market price one day is £1 equal to 50 American dollars. So if I'm a broker, I have to buy myself a pound for $50 and supply you to 150. But I have to. Remember, the choice is only with the buyer, not with the seller. When I say, like you have a choice, see here, when the price was 1.46, you never came to me, did you? You didn't come to me. 148, 149, 149.99, you never came to me. Did I force you? So this, you have an option not to exercise the option. But I, the seller, can't run away. I can't run away. The only time I can do is that I can pray that you never come to me. So if the option is out of the money to you, then I gain. Make sense? So there is some inherent kind of unevenness, discrimination against the seller. So this is very pro-buyer contract, but don't have too much sympathy to the seller because buyers are individuals. Seller are having such contract, thousands of contracts on daily basis. So if you're losing on one, you're gaining on others also. Does it make sense? So they are the big multinational banks, so it doesn't really matter. If they lose on one contract, they can gain on thousands and dozens of other contracts. So it doesn't really make any difference to them. Okay?
So most of the contracts are not used. The companies don't use.
No, when to exercise or not to exercise, you decide when you compare the strike price, the contract price with the market price.
I understand, but in reality,
Yeah, it may happen. I won't say that whether the price would go down or up in the future. But if you're a buyer of the option and I'm the seller of the option, you will always be looking forward for the option to be in the money. So the price in the future rise so that you buy cheaper. When everybody else is buying expensive, you buy cheaper. And for me, it's an adverse situation that I'm buying expensive something for you and then sell cheaper to you. You know, I buy for 156 and provide you at 1.50.
So you're a seller, you take more risk because your losses can be unlimited.
Huge, yeah.
But I'm more safe to you.
You are more safe, yeah. This is why I said that it seems to be pro-buyer contract. But as I said, that it's not the case, it's only a perception, because in reality, a broker or a bank can gain or lose many contracts on daily basis. So basically on one day you may lose, but then on the other day you gain, right? And also sometimes it's a compulsion. When all the rival banks of yours are having these contracts, you can't run away from it. It's like a one-stop shopping. You like to shop everything from one store, don't you? Even though you visit 3 stores, but on the weekend, you want to see all the things which you find in Prisma, also in K Market, so that you can compare the prices. You never like a store where certain things are absolutely missing. So sometimes it's a market pressure that the banks have to have those products available. Otherwise, you can move your account to some other bank. So sometimes it's a market pressure also that you have to have those contracts. But do you get the idea that for the seller, the upside potential is limited? For the buyer, downside risk is limited. But for the seller, the downside risk is unlimited. Whereas for the buyer, the upside potential is unlimited. So it's like a complete, did I say opposite? So basically, the buyer's gain is unlimited, but buyer's loss is limited. Seller's gain is limited, but seller's loss could be unlimited. Yeah. Once again, as a buyer, you will be always praying the option to be in the money. As a seller, I would always be praying option to be out of the money, because that's the only time I gain. These are the quotes. As a student of finance, you must be able to read the financial media, like Bloomberg page or something like that. Can you see here? Euro contract. All right. CME. Have you heard CME before? What is that? Chicago Mercantile Exchange. The contract size is how much? Oops, sorry. 125,000. It means that if you want to buy one contract, the minimum size of euro you must buy is 125,000. Okay. And the first column is strike price. Imagine the strike price is 1.1. Sorry, 115. How many zeros? 2 zeros. Can somebody tell me what is this? What is this? 11500. What is this? 1, 2, 3, 4. Where are you in this case? In America, in US, yeah? If the strike price is this, and imagine that you want to buy the contract which is expiring in July. Can you see here? July, September, and December. And let's say if you want to buy the strike price this, and you want to have a July contract, so this is the strike price. The premium is how much? Premium is opposite to 11500 is, because it is in cents, so I would say 0.2812 cent. Yeah. So you have to pay the premium upfront 0.28 for each euro to buy the contract. So this is the strike price, and this is the premium of the option. All right. This is something similar to this question. Strike price, premium. Yeah. It means that if you're a buyer of the option, the maximum loss you can have for every 1 euro is this much. But then the upside potential is huge. All right. And the maximum gain which the seller of the call option can have is 28 cents. He will not get anything more than this. Yeah.
How is the 28.120?
Well, 28.120 or cents.
Even the strike price is in cents, right?
Well, there is a way that we take 4 decimal places and then put 0.
So you divide the call price.
28 cent means $0.28. Yeah.
You divide the call price by the divide the 100.
Where do I divide? Premium?
No, yeah.
Yeah.
The premium you divide it by 100 because you have to convert it to cents.
Yeah, but here I don't divide anything. It's a convention that we leave 4 decimal places. It's a matter of convention. Yeah. So there's no division here, but of course for 28 cents there is a division, conversion of cents to dollars. Yeah. Okay. Is okay? It is actually, yes, it is. Because if you are afraid of fluctuations, then it's a big amount of money. And remember, this is also big because you have option. There's nothing is forcing you. Imagine a situation forwards. Things go against you. You still have to honor the contract. And again, lost something. But here, you can choose not to exercise the contract. But still, of course, you have to pay the premium for this extra advantage. Huh? Yeah, we shall discuss about it. Yeah. But I want to show you something. Let's say one more strike price, 11950, which is here. 1.1950. So I leave 4 decimal places, 1, 2, 3, 4. And then the premium here is 23,620, which means 0.2362. I want to ask you one thing. When the strike price goes up, the premium goes down. Why so? So if you see this column and this column, you may observe that as the strike price is going up, the premium is going down. Is it purely coincidental or is any logic behind it?
The risk is reducing. The risk reduces and the premium is.
Whose risk reduces? Seller's risk reduces. Can you elaborate? How does seller's risk reduces?
Because they are selling at a higher price, strike price. So in case the fluctuation is way more than what you anticipated, so you're paying them more money. For example, let's say that I go to a seller. Okay, I say I'm buying $125,000, and I fear that the fluctuation will be around. It may fluctuate from somewhere between 1.1 to 1.3, but I don't know exactly what it is. I don't know.
I try to make a simple example. Let's say it's me who buy both contracts. So I buy 2 option contracts. Everything is same. I'm the same buyer. But first of all, I buy this contract and at the same time I buy this contract. Now imagine on July 3, when both will expire, on that day, July 3, the market price is now I want to ask you something. Which of my option is in the money and which of my option is out of the money? You know what is in the money option? Look, the market price on July 3 is this, yeah? My strike price is 1.1500. Should I exercise the option or shouldn't I? Don't look at the premium because it's paid already. It will never come back to you. Compare this with this. I should use or I should exercise the option. It means my option is in the money. When option is in the money, buyer gains, the seller lose. So in this battle, who wins? Buyer. What about this one? The buyer lose. Because if he exercises the option, he means the buyer exercise the option, he pays 1.1950, whereas the market price is 1.1720, cheaper. So in this case, your option is out of the money. In this case, option is in the money. So what we conclude that as the strike price increases, the option will be out of the money, probability goes up. And hence the premium reduces. Why would I buy an option who 80% is going to be out of the money? You get my point? When you compare this with this with this, you find that this is ITM, means in the money when I should be very happy. This option is out of the money option. Sorry?
Lacking one. Yeah.
Oh, I'm sorry. Sorry about it. But now it makes sense? Mm-hmm. Yeah. Remember I mentioned about cacography. I won some prize in cacography. Not only once, but I won many prizes in cacography. You can see this? Yes. Sorry, I forgot it. So there we go. So you can see now this with this. The market price is more. The contract price is less. Why shouldn't I use it? So it means that broker is buying by himself at this price and giving me at this price. I'm winner. Option is in the money. The probability, those options who are more probable to be in the money would have more price also. Simple economics. The probability, the strike price is higher. The market price is less. I would rather buy from the market. And if option remains OTM, out of the money, well, the premium is less. Why would I buy an option who is highly likely to be OTM? Well, if I buy, then give me a discount. Charge less price. So there is a negative relationship between the option premium and the strike price. All right.